Hi students, let us start concept number 2 relating to PDD or RDD or RBDD. So concept number 2 means question number 2, or you can take it as a type number 2. Mr. A and Mr. B are partners in a firm. In this partnership firm there are two partners, Mr. A and Mr. B, sharing profits and losses in the ratio of 2:2. What is the profit sharing ratio? 2:2. Their balance sheet as on 31st 3 2024 was as follows. Here was is used. It means it is an old balance sheet. Balance sheet as at 31st 3 2024. Left hand side capital and liabilities amount rupees. Right hand side assets amount rupees. Capital and liabilities capitals Mr. A, Mr. B. Assets debtors 20,000 gross amount less PDD old PDD 1,000 net amount 19,000. On 1/4/2024 Mr. C is admitted into partnership on the following terms. This question is relating to admission of a partner because the word used is admitted, means admission of a partner. On which date new partner is admitted into partnership firm? On 1/4/2024. Now summary is that who are the old partners? Mr. A and Mr. B. What is the old profit sharing ratio? 2:2. What is the old balance sheet date? 31st 3 2024. What is the admission? What is the date of new partner's admission? 1/4/2024. Who is the new partner? Mr. C. Adjustments. Maintain provision for doubtful debts at 6% on debtors. They are using the word maintain. How much percentage? 6%. Now the question arises, sir, whether we have to calculate the 6% on this 20,000 or rupees 19,000. So we sold the goods on credit worth rupees 20,000, not 19,000. We have a doubt on this 20,000, not on this 19,000. That's why whenever you want to calculate the PDD, you have to calculate the PDD on this gross amount, that is on 20,000. They are asking you, show how do you treat the PDD. Now everybody take the calculator. 20,000 into 6%. It is 1,200. But old PDD is 1,000. 1,200 is a new PDD. So old PDD is 1,000. So old PDD minus new PDD. The difference is 200 is increase in the PDD. Okay. I think everybody understanding the question. Pause the video right now and note down this question. Let us start solution. Solution to concept number 2. Revaluation account. Draw the revaluation account format like this. Debit side expenses and losses amount rupees. Credit side revenue, that is income profit gain amount rupees. Or you can write particulars on both the sides. See, when there is increase in the PDD, as per the American accounting system or accounting equation approach, two accounts involved are, one is revaluation account, another one is PDD account. Revaluation account, if there is expenses and losses, we have to write on the debit side. If there is income profit gain or revenue, write on the credit side. So revaluation account debit side is ruled by the expenses and losses account. Credit side revenue account. Now when there is increase in the PDD, PDD is a liability. PDD is a liability. Provisions are always liability. So increase in the PDD means increase in the liability. Increase in the liability, credit. Because of increase in the liability, there may be a loss. So increase in the expenses and loss is debit. For increase in the PDD, what is the journal entry? Revaluation account debit to PDD. Now as per the England system or British system, revaluation account is a nominal account. Provision for doubtful debts is a personal account, is a representative account. So that's why for increase in the PDD, revaluation account debit, nominal account debit the expenses and losses. PDD personal account credit the giver. So what is the journal entry? Revaluation account debit to PDD. Check here. Revaluation account debit to PDD. New PDD minus old PDD. New PDD, take the old balance sheet debtors 20,000 into 6 by 100 minus old PDD given in the question old balance sheet 2,000. So 1,200 minus 1,000. So what is the increase in the PDD? 200. So that's why for increase in the PDD, you should write on the debit side. Why? Revaluation account debit to PDD. Step number 1 completed. Step number 2, new balance sheet. As at 1/4/2024. Draw the new balance sheet like this. Okay. Left hand side, capital and liabilities, amount rupees. Right hand side assets, amount rupees. Capital, Mr. A, Mr. B, Mr. C. Now there are 3 partners. Why? Old partners, Mr. A, Mr. B. New partner, Mr. C. Hereby there will be 3 partners. Mr. A, Mr. B and Mr. C. Debtors. Open the question. From the question, old balance sheet, debtors 20,000 gross amount, less PDD, old PDD plus increase in the PDD. Old PDD is 1,000 given in the old balance sheet plus increase in the PDD 200, that is from the revaluation account. Now 1,000 plus 200, it is 1,200. 20,000 minus 1,200, the difference amount is 18,800. So I think everybody understood the concept. Students, please comment if you like it, like it. If you are not understanding, write the doubts, write your name, college name, city, and share it to the PUC 2 students, class 12 CBSE students, class 12 ISC students, because these concepts are same in all these cases. I am going to solve the question paper relating to PUC, new question bank, or CBSE question bank, ISC question banks. Okay. Once all concepts are cleared, I'll separate the videos relating to PUC, relating to CBSE, relating to ISC. Okay. So thank you.